Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're taking a deep dive into the second quarter 2025 results from X Financial.
Yeah, and this was a really interesting one.
Definitely, because, on the surface, the company reported just stellar growth, strong profitability, significant improvements in asset quality, too.
Right, and a clear capital return strategy on top of all that.
Exactly. But then the market's initial enthusiasm, well, it seemed to cool off pretty significantly by the end of the trading day.
It really did. Kind of a head-scratcher initially.
So what actually happened here? What are the real takeaways from this call, and what's it mean going forward?
It's a fascinating situation, isn't it? You've got this strong operational performance clashing with let's say a cautious market. When you look at the actual headline numbers for Q2 2025, X Financial, they really delivered.
Okay.
They hit record loans facilitated and originated RMB 38.99 billion.
Wow. Okay.
Yeah, that's a robust 71.4% increase year over year. Pretty substantial.
And that kind of growth, it fed right into the top line, I assume.
Absolutely. Total revenue came in at $317.3 million. That's up a huge 65.6% year over year.
Okay, so big numbers. But it wasn't just volume, right? You mentioned profitability shown too.
That's the key point. Their non-GAAP earnings per share, it surged to $1.98 per ADS.
Right.
That's an impressive 85.8% jump compared to last year.
And just quickly, non-GAAP and ADS.
Good question. So non-GAAP earnings, basically they adjust for some one-off items or non-cash things just to give you a clearer picture of the core business profitability.
Got it, like the underlying health.
Exactly. And ADS, that's American Depository Shares. It's how shares of a foreign company like X Financial trade on a U.S. stock exchange.
Okay, makes sense. So that big jump in earnings per share, even adjusted, shows real leverage.
It does. But what's equally important here is the asset quality improvement. That really stood out.
How so?
Well, their 31 to 60 days past due rate, the DPD rate, it fell to 1.16%, which is nearly 10% better year over year. And maybe even more telling, the 91 to 180 DPD rate dropped significantly to 2.91%. That's a 33% reduction year over year.
So fewer loans going bad and for shorter times. That sounds pretty crucial for a lender.
It's absolutely critical, yeah.
So these results, they definitely sparked some initial excitement, right? Pre-market looks strong.
Oh, yeah. Shares were up noticeably before the bell. But like you said, as the trading day went on, that excitement just evaporated. The stock actually closed lower.
So what gives? Why the disconnect between the strong numbers and how the market ultimately felt?
That's really the core question we need to unpack, isn't it? Let's first maybe dig into the operational momentum that actually produced these numbers.
Good idea.
The company saw a huge surge in active borrowers. They reached 2.85 million.
Wow.
That's a 73.7% year-over-year increase. Just massive growth in their user base.
And that drove the loan volume.
Exactly. Total loans facilitated hit about 3.72 million, up 70.8% year over year. The average loan size was around RMB 10,476, so lots of new customer relationships.
That's a huge expansion. But the classic question with high growth is always, is it profitable growth? Are they keeping things efficient while scaling up so fast?
Right, and the answer seems to be yes. Their non-GAAP adjusted net income, it was up 58.3% year over year to $82.8 million.
Okay.
What's really impressive, I think, is that they kept their operating margins strong, near 30%, even while spending more on getting those new borrowers.
So good unit economics then. Each new customer is actually adding to the bottom line.
Precisely. It shows very efficient unit economics, and their return on equity, or ROE, also improved quite a bit, hitting approximately 27.9%.
And ROE tells you?
Basically, how much profit they're generating for every dollar of shareholder equity invested in the business. So nearly 28 cents on the dollar here. That shows really efficient use of capital.
Okay, so operationally, financially, the numbers look solid, robust even, but management seemed to really stress this theme of disciplined execution and focusing on asset quality. Was that just talk, or are they actually doing things differently?
No, it seems quite genuine. They really hammered home that asset quality isn't new. It's always been a priority. They're not just chasing volume for volume's sake.
Right.
And this disciplined execution, it translates into real actions. They talked about rigorous underwriting, being careful who they lend to, and disciplined borrower screening. Plus, they're proactive. They engage with borrowers, offer customized repayment help if needed. These practical steps are what drove those better DPD rates we talked about.
Makes sense. Quality over just quantity. And what about tech? AI is everywhere now. Is X Financial using it?
They are quite significantly, actually, especially in client management, things like collections and customer service.
Oh, interesting.
Yeah, they specifically mentioned AI replacing some live agents. So that points directly to, real cost savings and better efficiency.
So it's not just hype, it's actually impacting operations.
Seems so. They see it as an ongoing way to cut future costs and boost profitability. It's part of that efficiency drive.
Building for the long haul, sounds like.
Sure.
Which usually brings us to shareholder returns. How are they treating their investors?
Very well, it appears. They seem strongly committed to returning capital, and that's usually a good sign, right? It shows management's confidence in cash flow and the balance sheet.
Definitely. What are they doing specifically? Buybacks? Dividends?
Both. Year to date, they've already bought back about 16.7 million Class A shares. That's like 2.3 million ADSs, costing them $47.7 million.
And they're not stopping there.
Nope. They announced a new $100 million share repurchase program. It's active through late 2026, and they still have about $68 million left on that.
That's significant. And that helps existing shareholders how?
Well, fewer shares outstanding means each remaining share owns a slightly bigger piece of the pie. It directly contributed to a 14.4% year-over-year drop in the share count, which helped boost that earnings per ADS figure we mentioned earlier.
Got it. And dividends too.
Yep. They just declared a semi-annual cash dividend of $0.28 per ADS. Record date is September 26, payment around mid-October.
Okay.
So taken together, buybacks and dividends, it paints a picture of strong confidence from management about the business's health and future prospects.
Right. So let's circle back. We have incredibly strong Q2 numbers, this strategic focus on quality, AI efficiencies kicking in, a solid capital return plan. Yet the market reaction was muted, maybe even negative by the close.
Exactly.
Let's get into that investor context, starting with their guidance for Q3. It sounds like they might be tapping the brakes a bit.
They are. For Q3 2025, they guided for total loan facilitation and origination between RMB 32 billion and RMB 34 billion.
Which is down from Q2's record level.
It is, and it's deliberate. Management framed it as prioritizing asset quality and profitability over just hitting volume targets. It fits right into that scale and discipline mantra they kept repeating.
So Q3 becomes kind of a prove-it quarter then.
Yeah.
If they deliver on this moderated growth and keep delinquencies stable or improving,
That could be a major catalyst. Yeah, it would validate their strategy in the market's eyes, especially after the cautious reaction to the strong Q2 numbers.
makes sense.
Yeah.
What about regulations? China's consumer finance space, it's always evolving. How are they handling that?
Management sounded quite positive, actually. They stressed they're fully committed to compliance, aligning with policy goals like responsible lending, consumer protection, all that.
Positive. Usually companies aren't thrilled about more regulation.
Their take is that clear rules actually create a more sustainable industry. It weeds out irresponsible players and encourages responsible innovation. They see it as potentially helping them long term.
Interesting perspective. An advantage almost.
Potentially, yeah. If they navigate it well, they emphasize they engage proactively with regulators.
Okay, so the company feels good about its strategy, the regulations.
Yeah.
But back to that market disconnect. What other reasons could explain the investor caution despite everything looking good on paper?
It's tricky. I think a few things are potentially at play. First, even if moderation is strategic, any slowdown in growth can make investors nervous, especially in tech or finance sectors known for speed.
Right. The market might see discipline as just slower growth ahead.
Possibly. Second, you can't ignore the broader China macro picture. Concerns about the economy, consumer spending, that can cast a pall over everything, making investors jumpy about any sign of deceleration.
Even if it's planned deceleration.
Exactly. And third, if you look at X Financial stock, XYF, it's actually lagged the broader China tech index, KWB, quite significantly recently.
Oh, really?
Yeah, over the last 1 and 3 months, KWE has seen gains, while XYF has lagged, been more volatile, and had a sharper recent drop. That suggests maybe some specific skepticism about XYF or its niche.
So the overall vibe is cautiously bullish. The fundamentals look strong. Management seems focused, but the market needs more convincing. Q3 execution is key.
That sums it up perfectly. It's a real show-me story now. Strong core business, good strategy, capital returns, but wrestling with market sentiment and broader uncertainties.
Okay. And that brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on all this. Remember, purely for discussion, investing involves risk.
All right. So given this whole prove-it quarter dynamic for Q3 and the potential for a re-rating if they deliver on that disciplined growth and asset quality, you could consider a bullish options play. For example, maybe buying a moderately out-of-the-money call option on XYF shares.
Okay, define moderately out of the money.
Meaning a strike price somewhat higher than the current stock price. And you'd want an expiration date after the Q3 earnings are expected, probably late November or early December.
So it's a bet that they successfully navigate Q3, impress the market that faded on Q2 news, and the stock moves up significantly.
Exactly. It's aggressive. It offers potentially big upside if Q3 delivers that positive surprise and re-rating, but of course, huge risk too.
Right. If the stock struggles or they miss, those options could expire worthless.
Precisely. Options are risky. Definitely not financial advice, just an idea based on the dynamics we discussed.
Got it. So to wrap things up, X Financial put up strong Q2 numbers. They're deliberately shifting focus to quality and profitability over pure speed, and they're returning cash to shareholders.
That's the core story.
But the market's watching Q3 like a hawk. It's really a critical test for their scale and discipline approach. Can they prove it works and win back that market confidence?
That's the big question. Will Q3's disciplined execution finally convince the market and lead to that reappreciation, or will those external factors keep weighing things down? It's definitely one to watch.
Absolutely. Well, thank you for joining us for this deep dive into X Financial's Q2. Remember, all this is just for informational purposes. It's not financial advice. Always do your own research.
Indeed.
Until next time, stay well informed.